Hello, and welcome to the rentyourstock.com video series. My name is Walter Engelbrecht, and today I'm going to teach you how to earn extra rental income from your favorite stocks. Just as real estate landlords rent houses, I earn extra income by renting my stocks to other investors. It's so easy that my retired mother, who had never bought or sold a single stock before, is now enjoying a steady cash flow from her stock rentals. Moreover, my skeptical father, after having rented his own stocks, can't believe people still invest without the portfolio protection that comes from renting your stocks. Over the next hour, I'm going to teach you what I've taught countless friends, family, coworkers, and neighbors: how to immediately start earning extra income by renting your stocks. Before we get started, there are two housekeeping items we have to cover. First, the disclaimer, and second, the terms and conditions. Please download both documents and read them before continuing. By continuing to view the rentyourstock.com video series, you hereby agree to the following. 1. You acknowledge that rentyourstock.com and its staff are not investment advisors, financial advisors, or licensed securities brokers. 2. Information from rentyourstock.com and its staff is for educational purposes only and is not a direct recommendation to buy or sell securities. 3. Rentyourstock.com and its staff are not responsible for gains or losses incurred as a result of your decision to utilize the methods demonstrated herein, or your decision to trade any stocks listed herein. 4. The information given is only intended to be an aid to your own investment process, and your investment actions should solely be based upon your decisions and research. 5. You should seek advice from a licensed investment professional before utilizing any of the techniques demonstrated herein. And 6, rentyourstock.com and its staff are never compensated in any way for listing or mentioning any stocks or securities in any of our materials. While we're speaking of financial advisors, let's take a quick look at their track records. In 2012, according to Forbes magazine, more than 66% of U.S. equity mutual funds failed to beat the market. In 2011, it was even worse. More than 84% failed to beat the market. Economics professor Burton Malkiel once said that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. Sounds crazy, right? Well, Malkiel was wrong. Monkeys can't pick stocks as well as financial professionals. Monkeys do better, every time. Researchers looked at monthly U.S. share price data from 1968 to 2011 and used a computer to simulate the random stock picking abilities of a monkey, and pitted these random choices against traditional market capitalization weighted indices. And the monkey won every time. Moreover, according to a recent study by the National Bureau of Economic Research, most so-called financial advisors fail to provide objective advice to their clients. The study concluded that the majority of financial advisors will steer clients towards products and services that increase an advisor's income, instead of doing what's in the best interest of you, the client. None of this surprises me. I'm a serial entrepreneur, and one of the companies that I started, EcoPhones, grew to become one of the largest cell phone recyclers in the United States. When I sold the company, I didn't really know what to do with my newfound wealth, so I did what any smart person would do. I deposited my hard-earned money with a very well-known and venerable financial asset management company. I'll never forget their commission structure. It was quite an eye-opening experience. Each quarter, they would deduct a fixed percentage of my total assets, regardless of whether or not they had made me any money. In fact, they even got paid the same percentage if they lost some of my money. I couldn't believe it. I just assumed that financial advisors and their companies only profited if they made their clients money. To add injury to insult, I was assigned a so-called advisor fresh out of college. He had absolutely zero real-world investing experience. Needless to say, I decided to manage my own money, and I've done very well for myself. So much for so-called financial advisors and their advice. Aside from inexperienced or unethical financial advisors with misaligned commission structures, all of which eat away at your portfolio, the stock market is fraught with even greater perils. CEO scandals, accounting frauds, insider trading, and flash crashes are all occurring with increasing frequency. Any one of these ticking time bombs can decimate even the most conservative portfolio. As we were filming this video, the Internal Revenue Service filed a claim against Tyco for nearly $1 billion in back taxes from 16 years ago. That's right, 16 years ago. Moreover, 4 former subsidiaries of Tyco may have to contribute and help pay Tyco's tax bill. That's 4 additional companies whose stocks are getting unfairly pummeled for something their former parent did 16 years ago. Can you imagine how you'd feel if you owned stock in Tyco or any of those 4 former subsidiaries? Tyco isn't an isolated case by any means. According to the Wall Street Journal, large U.S. companies have been restating financial results in increasing numbers over the past 3 years, with the total number rising 21% last year and rising 60% since 2009. As you can guess, the restatements never show newfound revenues or more profits. It's always bad news. The Securities and Exchange Commission, the SEC, just reported that it has filed more insider trading actions in any 3-year period in its history. CEO scandals are on the rise as well. And it's not just people that you have to worry about. It's the underlying technology as well. The flash crash that occurred on May 6, 2010 wiped out $1 trillion of market value in less than a half an hour, with share prices of some major multinationals plunging to almost zero. Financial information giant Thomson Reuters provides elite traders with certain market-moving consumer survey results prior to the release of that information to the general public. This advantage often comes at the expense of most retail and institutional investors who don't get to see the information until it's too late. It makes you wonder what other key data is being shown to elite traders before you and I get to see it. It's no wonder that just 15% of Americans trust the stock market, and that 40% of 18 to 30-year-olds believe they will never feel comfortable enough with stocks to invest in them. But we can't just bury our heads in the sand. We can't just stop investing in the stock market. History shows that stocks outperform all other forms of investments. In today's low interest rate environment, parking your money in a bank account, money market account, or CD is akin to putting it under your mattress. The stock market, despite its pitfalls, must play a key role in every investor's wealth building strategy. That said, it's not all doom and gloom. Fortunately, renting your stocks to other investors mitigates some of the inherent risk associated with investing and to a degree bulletproofs your portfolio. In this series, I will show you step by step how to collect rental income from your stocks, explain why people want to rent your stocks in the first place, and show you what to look for in great rental stocks. And lastly, illustrate advanced stock rental strategies to enable you to rent your stocks under any and all market conditions. When I asked my parents why they hadn't taught me, they apologized and told me that no one had ever taught them. Well, I never want to have to apologize to my 1-year-old son and 3-year-old daughter. So I made this video for them so that they never ever invest without a parachute. You shouldn't have to either. Speaking of parachutes, I'd like to conclude this first lesson by elaborating upon the parachute analogy and give you a real-world stock rental example to whet your appetite. A few years back, my parents purchased shares of Boeing, the large aircraft manufacturer, at around $80 per share. Today, the stock is trading at over $100 per share. My parents could easily sell the stock and pocket their profit of $20, but instead, they regularly collect rent of approximately $10 per year from other investors. If they continue to rent the stock for a total of 8 years, the rental income will have paid for the stock. Just as a real estate landlord hopes that their renter pays off the mortgage on the landlord's rental house, we too want our stock renter to pay off the original purchase price. More importantly, if shares of Boeing drop, my parents are somewhat protected. There's that parachute again. Any drop in Boeing stock price is partially or wholly offset by the total rent my parents have previously collected from the stock. For example, recall that my parents bought Boeing stock for $80 a share. In addition, let's assume they've collected $40 per share in rental income over the last 4 years. If the stock gets cut in half and drops from $100 to $50 per share, my parents are still $10 ahead. How? Well, they'd still be holding Boeing stock that they could sell for $50 per share, plus they collected a total of $40 in rent. 50 plus 40 equals $90. Subtract their original investment of $80 and they're left with a $10 per share profit. In addition, because my parents retain ownership of the stock, They also collect the annual dividend payments from Boeing. Now that's a safer and smarter way to invest. Now let's dive into lesson number 2 and learn step by step how to collect rent year after year from our stocks.